Ever wondered how the financial performance of Walt Disney compares to Comcast? Well, you're in the right place. Walt Disney and Comcast are two of the leading entertainment and media conglomerates in the United States, each with their unique strengths and areas of focus. When we look at their financial performance in 2023, we see some interesting figures. Walt Disney generated a total revenue of $89 billion, while Comcast outpaced them with a whopping $122 billion. But what do these numbers mean? And how do they translate into the overall financial health and potential growth of these entertainment titans? That's exactly what we're going to explore. We'll break down these revenues, analyze their profit margins, assess their assets and liquidity, and much more. In this video, we will dive deeper into the financial performance of these entertainment giants. Let's start with how they earn their money, shall we? In 2023, Walt Disney pulled in $89 billion in total revenues, while Comcast raked in a hefty $122 billion. When compared with the figures from 2018, Disney's revenue grew at a compound annual growth rate, or CAGR, of 8%, and Comcast's revenue increased at a CAGR of 5% over the same 5-year period. The revenue of Walt Disney is diversified, with 19% coming from affiliate fees, 20% from subscription fees, 13% from advertising, 12% from theme park admissions, 9% from resorts and vacations, and the remaining 27% from other operations. Comcast's revenue structure is more concentrated, with 59% from residential connectivity and platforms, 8% from business services connectivity, 21% from media, 9% from studios, and a mere 3% from other sources. Geographically, Walt Disney generates 80% of its revenue from the Americas, 11% from Europe, and 9% from the Asia-Pacific region. On the other hand, Comcast earns 78% of its revenue from the United States, 11% from the United Kingdom, and the remaining 11% from other regions globally. These revenue streams play a significant role in shaping the financial health of both companies. Stay tuned as we delve deeper into the profit margins and net profits of both Walt Disney and Comcast in the next scene. Now let's talk about profit margins and net profits. Profit margins, as we all know, give us a glimpse into how much a company earns relative to its revenue. It's a key indicator of a company's financial health. Now let's look at how our two entertainment giants, Walt Disney and Comcast, stack up. Over the past 5 years, Walt Disney's net profit margin has seen a bit of a roller coaster ride. It was at 7% on average, but by 2023, it had dipped to 3%. This suggests that despite increasing revenues, the company's net income hasn't kept pace. On the other hand, Comcast has managed to maintain a steady net profit margin over the years. With an average of 11% over the past 5 years, it peaked at 13% in 2023. This consistency is a positive sign, indicating that Comcast has been able to effectively manage its costs while growing its revenue. Now, let's shift our focus to net profits. In 2023, Walt Disney's net profit was a respectable $2.4 billion. However, when we compare this to Comcast's net profit of a whopping $15.4 billion, we can see a stark contrast. These figures highlight the significant differences in the profitability of these two companies. It's important to remember that net profit isn't just about the numbers, it's a reflection of a company's efficiency, its strategy, and its competitive advantage. When it comes to growth, Walt Disney's net profit has seen a compound annual growth rate, or CAGR, of negative 28% over the past 5 years. On the other hand, Comcast's net profit has grown at a CAGR of 6% over the same period. So what does all this mean? Well, it's clear that Comcast has an edge when it comes to profitability. But remember, investing isn't just about looking at the numbers, it's about understanding the story behind those numbers. Remember, a healthy profit margin is a good indicator of a company's financial health. Assets and liquidity are crucial to any business. Let's see how Walt Disney and Comcast stack up. We begin by looking at the total assets for both companies. As of the end of 2023, Walt Disney holds total assets worth $206 billion, while Comcast has total assets worth $265 billion. But total assets aren't the entire picture. Let's also consider net assets. For Walt Disney, the net assets amount to $104 billion, while for Comcast, they stand at $83 billion. Now, the equity to total assets ratio examines the proportion of a company's assets that are funded by shareholders' equity. For Walt Disney, this ratio is 51%, while for Comcast, it's 31%. This suggests that a larger proportion of Disney's assets are financed by equity compared to Comcast. Moving on to liquidity, which is the ability of a company to meet its short-term obligations. The current ratio is a liquidity ratio that measures a company's ability to pay off its liabilities with its assets. For Walt Disney, the current ratio is 1.05, while for Comcast, it's 0.6. This implies that Walt Disney is more capable of covering its short-term liabilities than Comcast. However, the current ratio has a small flaw. It includes inventory, which might not be easy to quickly convert into cash. That's where the quick ratio comes in. It excludes inventory from current assets. For Walt Disney, the quick ratio is 0.99, almost identical to its current ratio. For Comcast, the quick ratio is also 0.6, the same as its current ratio, indicating that neither company heavily relies on inventory. In summary, both Walt Disney and Comcast have significant assets, with Disney having a higher proportion of its assets financed by equity. When it comes to liquidity, Walt Disney appears to be in a better position to cover its short-term liabilities based on both the current and quick ratios. These figures give us insight into the financial stability of both companies. Operational efficiency and cash flow are key to understanding a company's financial performance. Let's begin with inventory management. For a company like Disney, it takes about 11 days to sell off its inventory. Comcast, on the other hand, has an inventory day count of 0. This means that Comcast is able to turn its inventory into sales immediately, which is a sign of robust operational efficiency. Another important metric is accounts receivable days. This is the average number of days that a company takes to collect payment after a sale has been made. For Disney, this figure stands at 51 days, while Comcast is able to collect its dues in 40 days. The lower this number, the better it is for the company's cash flow. Now let's look at operating cash flow, which indicates how much cash a company generates from its core business operations. In the case of Disney, this figure is $9.9 billion, while for Comcast, it's a whopping $28.5 billion. But the cash flow story doesn't end here. Free cash flow is another important indicator to consider. It represents the cash a company is able to generate after spending the money required to maintain or expand its asset base. Disney's free cash flow stands at $4.9 billion, whereas Comcast's free cash flow is significantly higher at $16.5 billion. Lastly, let's compare the ratio of operating cash flow to net income for both companies. For Disney, this ratio is 4.1, indicating that it generates 4.1 times more cash from operating activities than its net income. For Comcast, this ratio is 1.9, which means it generates almost twice as much cash from operating activities than its net income. These figures reveal how effectively each company manages its operations and cash flow. Finally, let's look at the Dupont analysis for a comprehensive view of their financial performance. For the year 2023, Walt Disney's return on equity, or ROE, stands at 2% with a net profit margin of 3%. Their asset turnover ratio is 0.43, and their asset to equity ratio is 1.98. On the other hand, Comcast boasts an ROE of 18%, a net profit margin of 13%, an asset turnover ratio of 0.47, and their asset to equity ratio of 3.18. Clearly, in terms of ROE and net profit margin, Comcast outshines Walt Disney. This analysis provides a more nuanced understanding of each company's ability to generate returns and their relative efficiencies. And that's a wrap on our financial comparison of Walt Disney and Comcast. Which company do you think is a better investment? Share your thoughts in the comments below.